Hello and welcome everyone. Thank you for joining us. Today we've got Ryan McIntyre, President of Maverix Metals. We've got Kevin Bullock, President and CEO of Anaconda Mining, and also James Withall, CEO of Rupert Resources, joins us. Today, gentlemen, could I just get you to kick off and give us 30 seconds on each of yourselves? Ryan, why don't you start off with you, and then I'll go Kevin, James after that.
Sure. Well, Maverix Metals is a precious metals royalty and streaming company. We currently have 125 royalties and streams and expect to generate over $60 million this year at a 90% gross cash margin. We currently have a $700 million market cap and are dual listed on both the New York and Toronto stock exchanges.
Kevin Bullock, President and CEO of Anaconda Mining. Anaconda Mining is developing a large project in Nova Scotia called Goldboro, which is going to produce 100,000 ounces a year for 11 years plus. We currently have small production in Newfoundland and have been cash flow positive for the last 10 or so years, building an operating team in Newfoundland.
Hi there, I'm James Withall, the CEO of Rupert Resources. We're a Finland-focused exploration company that made the Ikkari discovery back in March 2020, and about 4 million ounces, 2.5 grams, so quite an exceptional discovery. We continue to move that forward towards engineering and development while still exploring the region, which is a pretty exciting part of the world. So currently we're well positioned with about 50 million Canadian in cash as well.
Guys, thanks for joining me today. Look, I want your help. We've had lots of questions sent in. I also want some help myself. So trying to understand what's going on in the market at the moment. We've seen in the last 3-4 weeks, retail step back from investing in the junior equity space. But institutions haven't. Money is available for mining companies that need it. But I suspect that's on a very sort of selective basis. Those companies need to meet certain criteria. So, I mean, where I want to go with this, and maybe Ryan, you're the best guy to start with, is why do you think it is that retail are slightly nervous at the moment? What's going on out there in the economy? What's driving that kind of step back?
Yeah, I mean, I think one of the big things is just all the uncertainty out there. I mean, you start off with inflation, which people see literally every day when they go to the grocery store or fill up their car with gas. And I think, as they cut up their budget, more is going towards, buying goods and services. And obviously, I think less is going towards investing. So I think it's partially a function of that. And then there's the other aspect of it as well is, inflation is typically not good for equities, generally speaking. And I think, from the gold side, I think it's a little bit different. And so I think generally speaking, the whole market pulls back, but the gold part's different. And I guess I can talk about Maverix and its strategy where we just hold royalties. So we just get a percentage of the royalty from various mines all around the world. And really there's no direct impact on us from inflation, but we do get the benefit of gold, which has been proven to be a great store of purchasing power over the long term.
Right. So as a retail guy, I'm going to be nervous because of inflation. It's going to affect my disposable income. It's going to affect, therefore, my discretionary spend. And you think that in investing, falls down the pecking order behind food, gas, electricity, heating, etc., as it should. So, Kevin, for someone like you, that's not good news, is it?
No, it's not. I mean, inflationary pressures are certainly a challenging environment to work in, especially when you're trying to develop something. Timing is an issue sometimes. If someone does a preliminary technical report and then a year later does a feasibility and people say, why did it go up 25%? Well, it didn't. It's just a point in time where things are 25% more expensive. And then, well, what's going to happen then by the time you get your permits and build? Is it another 25%? So that creates this risk tolerance that we're in right now. And you do say there's money in institutions, but not always, and they are quite selective. Right now, because of this volatility and people standing back, there aren't inflows into these institutions. So if they want to buy something new, they have to sell something they currently have. And they're reticent to do that in this volatile environment. So, what we do at Anaconda is, fortunately, with inflation, as Ryan said, the gold price does quite well too. And fortunately, we have limited production that helps us with higher gold prices as we're trying to develop. But one of the important things we have beside that is a very, very exciting exploration play next to our current 3 million ounce resource. So like James, that still is quite exciting, whereas development stories alone are are being looked at as, oh, we're unsure of what your actual cost is going to be and how much money you're going to need and whether that's enough. So we're getting that pushback about the development part of our story.
So James, tell me this: you've worked in the city as a financier, fund manager. You're now running a very successful exploration company. You've managed to sustain the story, which is great. But the bit what I want to come back to, and maybe want all of you to kind of answer, is why are institutions more right than retail in their decision to say, well, look, we will pick stories with strong fundamentals, and despite the economic movement, the uncertainty, we are going to put our money in here. Why would they decide to do that? Why shouldn't they sit back like retail, or why should retail invest like institutions?
I think Kevin mentioned the word volatility, and I think even in gold, you've had quite high volatility just of late. We had gold near on 2000 and back to 1900, and for ultimately, if you sort of, as a retail investor, that's quite a frightening situation to be in, because even what you thought was a safe haven, said, "Oh, buy gold, that protects you," even that's been quite volatile. So I think just of late, I think that's a bit, and obviously layer that with the inflation and the guys, especially on the operation side, where if you've got $100 move in the gold price and people are worried about your inflation effect going the other way, you sort of get this very, this increased concern in the short term, and people, as Ryan said, a bit of a rush to cash. They might just feel more comfortable in cash. So I guess that's to your first point. But I guess in terms of why maybe the institution's acting differently, as an institutional investor in the gold space, you should just be using the assumption that gold will hold its value relative to everything else. So if you use that assumption in your models, you can do that. That'll calm things down. You're probably not looking at spot gold price all the time and getting too worried about that. And so then you're making asset allocation on quality ultimately, and go back to looking for businesses that have high margins in this environment. So you want to find producers that have got high margins, so they'll sit in that space. You want to find exploration assets that have potentially high margins in the future, and then you want to find businesses that are going to find more gold ultimately through exploration. So they're just a lot more patient. They're just a lot more patient in their approach, so they can do that.
I think I totally agree with your comment on quality, but it's not only the quality of the asset, it's the quality of the team that's going to develop that asset. And we know in the industry that you can have an average deposit that does quite well with the right team engaged, but you can have a good quality project that gets destroyed with the wrong people. So it really is the quality of the team, the history of their success, and the quality of the project, obviously. But it takes all three.
But how do you define that? How do you say we need a good quality team? I've been there and done it before is a great line. You kind of want to hear this. I've done this twice before. That's fantastic. But not everyone's in that lucky position. So how do we determine what good looks like as it pertains to the management team? What would you say, Ryan?
Yeah, I think it's an experience thing. I think you meet enough people and you get a sense for people in terms of how they might behave in certain situations. I think Kevin and James both have correct. I think it's a combination of having people that you trust. So that's sort of an intuition that everyone, I think, has, and a combination of good fundamental underlying assets as well. And I guess to me, one of the big differentiators, and it's not really so much between, in my mind, institutions or retail, it's people that have the stomach and the psychology to basically invest when it's toughest, and conversely sell when it's the highest. And to me, it's that psychology that actually, to me, is the big differentiator. And in my mind, if you have trust in the people and the asset, or ideally one or the other or both, then you can really persevere and commit more capital when times are tougher, which is, I would suggest now, where the gold prices come down a little bit, equities have sold off reasonably amount. So I would suggest that it's probably a good time for people to make a counter-cyclical move and actually think about putting money into the sector.
I don't want to steal anything from Warren Buffett, but it really is the Warren Buffett mentality at the moment, in that if you buy something where you believe the fundamentals and you believe in the team and the asset, then if it goes down, you should not be upset. You should buy more. So, and that's the case. I think nowadays it's you've really got to pick the right assets with the people that have the history of bringing them through. And there are going to be up and downs. Nothing shoots straight up, except for Rupert.
Look, I think it is, from my experience, what do we do in my job? We just invested in just a smaller portfolio of really good quality companies. Just that whole approach, and that good quality comes across everything. It's the management, it's that transparency, it's the fact that they don't, in the current environment, make some short-term move that you just think, why, some left field moves, then why are you suddenly changing your business? Are they still making good investment decisions? You're an investor in the sector, so just look for the companies that are making or continuously have a good track record of making good investment decisions. And that's really what it comes down to. They are, they're investing the money that you put into the company in a way.
But contrarian investing sounds fantastic, but when the rubber hits the road, that moment arrives, you get all nervous, right? All logic goes out the window. You're like, well, what if? You kind of forget the planning, you forget the theory. It's kind of like the theory of like getting fit. Yes, I'll join the gym, and I will do some exercise. But actually, when it comes down to that moment, you might have to make that decision. It's tough.
I think that's sometimes the problem with some retail investors, including myself, sometimes is you can't invest and trade emotionally. So it's really important that what I said earlier, if you believe in the fundamentals and they have not changed and only the price of the stock has changed, then take that opportunity. Either it's gone up and you sell it because it's hit a point that you're willing to, that you believe is a reasonable value, or it's gone down and you want to buy more because you still believe it's going to go up. And you can't do that if you're doing it emotionally.
No, and this industry is famous for people falling in love with things at all across levels, whether it's geologists falling in love with assets and selling something. And I said to you before a few times, Matt, there's always this strong, if you just give me a little bit more money, it might look better, if you see what I mean. This thing. And I guess it's that, that emotion runs all the way through, but it is ultimately, you have to strip that back. And it's very hard to do that and have that discipline. Ultimately, even in institutional investing, you still have that as an element. And it's like, you think, no, I'll buy this leverage stock because I think the gold price is going to go up. But a leverage stock is usually a high quality business, not a high quality business. It's usually a high cost business. And so, a lot of people straddle for all these other ways to try and make money in these environments. But yeah, just go back to the fundamentals and keep some discipline.
So if I look at that, so where do you sort of sit then, James? I'll throw this one at you. Where do you sit between like sort of fundamental analysis versus technical analysis? Because what do you think?
So it's between fundamental and technical analysis.
Yeah.
So I guess I'd say they're sort of somewhat of the same, but
I meant technical from a sorry, we can see where you come from. I meant technical from a perspective of looking at past performance, just the numbers side of things, to be able to forecast what the company might do in the future, versus sort of.
Yeah, well, I guess I probably past performance is great, but it doesn't really. The fundamentals analysis is much more important. Like ultimately, there may have been a step change in that company in the past that was a driver for its past performance or past underperformance. So I guess you can look at that. No, I was never I'm not a big chartist or technicals on that side at all. It has to be based on the fundamentals and doing a bit more work. And I think, and that comes, and how do you actually do the fundamental analysis? It's quite hard, especially as a retail investor, to have the time to do that and to get the information you need to do that. And I think that's where the retail investor is a bit challenged. There's all this stuff out there that's saying this is a great company, that's a great company, do that, but really what's behind it? So, I think the best way to look at in technicals is probably to look back. For me, was always to look back through people's past news releases or presentations that they've given, if they're on their website, maybe for their last 5 years, and see what the consistency is in the presentation after the 5 years. That was a really good sort of, I'm thinking of like a odd technical thing that retail can do. That's quite an interesting way to do it.
I think I'm also not a big chart reader, technical analyst, but in my history, what I've noticed is if the fundamentals are right and continue to be right, and the technical analysis is showing a decline in the stock, that it may or may not go up. And if the technicals are right, saying a stock's going to go up, but the fundamentals are wrong, it may or may not go up. But when they match the technical analysis and the fundamentals, it's almost always going in the right direction based on that analysis. So, but I think the technical analysis isn't this really, it seems like a voodoo scientific mathematical thing, but at the end of the day, all it's telling you is really momentum drivers and what the market is actually doing. It's not company specific. As a matter of fact, the leading technical analyst at Bank of Montreal for years would do technical analysis on companies without knowing the name or what they did in what industry they were in. They would just do it based on the charts because it doesn't matter. It's just showing you momentum drivers and fundamental, the mentality of the market at the time.
And Ryan, where do you sit in this? Because you've got to get this right over multi cycles. When you make a bet, i.e., when you invest into a company, you're there, right? You're in it unless you flip unless you flip it to someone else, I guess. Whereas funds, private equity firms, institutions, they can trade in and out of the stock, right? They've got that option. You need to be really sure about your investment. So how do you look at it?
Yeah, when we buy royalties, our goal is to hold them forever. And so, basically our first dollars in are our last dollars in, and we plan it to be a permanent element of our portfolio. And I think one of the great things about, I guess, particularly on the royalty model of itself, is by its own nature, it's sort of counter-cyclical in a way, whereas you tend to see a lot more opportunities to do transactions in higher stress environments where prices tend to be lower just naturally. And conversely, in higher price environments, we generate more cash flow, which we build up and wait for those opportunities when things turn down or new opportunities arise where people require the money and you can actually get a good return. So I think, to me, it's getting in sync with that sort of cycle, because it is a cyclical business. I think as everyone knows, any commodity is. And I think, just going back to our previous discussion on, being able to withstand volatility, I think one of the key things is to rely on fundamentals. I don't think any chart of any type, whether it's positive or negative, is going to give a lot of people comfort if the price moves suddenly up or down. People will be wondering why it's moving up or down, particularly down, obviously, because that'll probably likely encourage people to sell even more. And so to me, it all comes down to the fundamental aspects of what is the risk and what is the return. And frankly, looking at operating businesses as well as, where are you in that cycle of, value add? So if you look at James and Kevin's businesses, they're very early on in that value add stage of its own company life cycle. You can feel confident that value will be added over time.
Okay, and Ryan, I just want to stick on this one because I struggle with technical analysis too, because I think companies and CEOs and boards are able to make decisions very, very quickly, which can make or break the fortunes of the company. And I think it's hard to kind of factor those things in. But if I look at some of the things which are the big topics at the moment, which may be affecting people's perception of the pluses or minuses of investing in junior equities, mining equities at the moment, which is, inflation is a topic talked in every conversation you're having at the moment, I suspect. But is inflation at the company level sustainable? Will prices come back down, or will they sustain, or will they continue to increase? And also, in coming back to the conversation we talked about retail in terms of disposable income and available to them, do you think that's going to come back down? So it's kind of, you're intertwined there, certainly on the explorer side. The junior exploration side, because if retail don't come back in, we may go back to sort of the situation we saw back in 2011, 12, 13, where retail came out of the market. And that caused big problems for brokers, problems for junior explorers.
Yeah, no, exactly. It's funny. I remember being on a panel back in 2015 with a series of other institutional fund managers. And I was the only one that had any desire whatsoever to invest in the junior side of the business. And to me, it's almost like the venture capital space. Well, it is the venture capital space of our sector. And to me, that's the spot that money flows out of the fastest, and where there's sometimes huge opportunities, just in terms of, because where it is in the value cycle. And to me, going back to fundamentals, I think it really is the driver of value in the business, is generating new exploration discoveries, new development projects, that type of thing. It's such a huge driver of value. And I think, from a retail investor standpoint, inflation certainly is a big concern, but I think one of the great things about, and even particularly on the exploration side, the gold's not going anywhere in the ground. And so gold tends to be a great mirror or beneficiary from inflation in the sense that it typically at least keeps up with it. And it's almost a direct correlation immediately. Whereas, if you're a general equity investor, you sometimes have to wait before prices react when they can adjust prices for consumers for those goods. Whereas this is more, I would say, direct drive and consistent with inflation. So I think it's probably one of the better, if not the best, investment to make in a high inflation environment.
I think one of the things that junior companies can be up against too as a challenge when they first start is liquidity. And you've got institutions and funds that say, we'd love to invest. It sounds very exciting, but our minimum investment would take over your company and then we wouldn't be able to get rid of it because there's no liquidity. But every large company with great liquidity started somewhere. So it's that gap in between convincing people this will become more liquid as it becomes more valuable, and it will become more valuable because we've got good fundamentals, and therefore, put a bit in now and stay with us and continue to do so. So, that's a challenge that, myself personally, having started several companies and brought them through, the beginning is always tough. Then exploration success is I shouldn't say easy, but you can raise money because you're into something and it's new and it's fresh. And then you get to development again, and you're going to hit this, what people call the flat line on the Lassonde curve. And our company, particularly at Anaconda, we look at that and we say, okay, there's a flat line now for developing our mine in Nova Scotia. We're going to stick a wedge in that and create quite some excitement by exploring next to it. Where's the best place to find gold is right next to a current large deposit or in the shadow of a head frame. And our extension to the west of our 3 million ounces has both of those. So, you create excitement to eliminate that potential of being flatlining while you're going towards what people consider boring development phase.
Yeah, but also you're not really, I guess, coming back to this inflation thing, I guess the developers are nervous because, as someone said earlier, these economic studies, the numbers are changing dramatically. And I've seen a few companies get really whacked. People who put studies out the beginning of this year, numbers were far higher than predicted for obvious reasons, but the market didn't factor that into the decision making. They got marked down, and it's been hard for them to come back. So that's what I'm sort of intrigued about. Is this inflation just, people transitory, temporary, or not? Will things get back to normal, or is there a new normal that we as investors need to be cognizant of? And obviously, what does that do to margins? Because gold is sitting at that 1900 mark again. It's not moving, and other commodity prices are shooting through the roof. So maybe it'll be okay. They all cancel each other out. But what effect does this current inflationary position and possible future inflation position have on companies' behaviour? I mean, James, how do you come?
I don't think it's that long ago since we experienced it. Really, you only have to go back to the financial crisis and everything about that, and then obviously we had this whole run in all commodities after that. But up to that, and you had this highly inflationary environment. Certainly on the construction side, you had record iron ore prices, steel prices going through the roof. For the industry, it wasn't that much. It has similarities. We had oil prices through the roof then as well. So you had energy costs, sky high. So we have been through this before, and obviously that did have an impact on producer margins. But ultimately, look at the gold price over the last 15, 20 years. It's more than compensated for that. So I guess it depends on the timeline of that investment for those guys, because when those guys put out a study and today there's an impact on inflation, perhaps that's an opportunity for these investors to actually buy in if they really think it's a good project, because by the time they bring the project into production, that relatively short-term impact of inflation or over multi-year inflation if the project's going to be around for 10 or 15 years, it's just a case, can they stomach that? So it goes back to Kevin's point. If it's fundamentally a really good thing that they want to invest in and the stock's got cheap, maybe it's a good time to buy some more. Because, unless gold's suddenly going to change its behavior that it's had for for tens and tens and tens of years, basically throughout modern financial history anyway, it's going to provide that natural hedge.
I think there's always an opportunity for rollovers in these situations because there's trailing numbers. What I see, and I'm not an economist, so I'm just a mining engineer. But what I see is it's a trailing number. So in other words, if you have really quick inflationary pressures and the costs are going up, the gold price is going to go up, but not exactly at the same time. It's trailing. And that's on the shoulder of inflation happening. What about the other end? Because it has to taper off. It can't go forever, and gold not go up along with it, or all gold mines are closed down, and that creates the supply demand curve again, and it comes back. But it's that delay of the two in sync that create some issues. And I think we're on the shoulder of this inflationary environment on the front shoulder of that moving up. And the gold price is going to trail, and you're always going to have that delta over time, but it's those shoulders that, and perhaps in 2 or 3 years when we're building a large mine, maybe the rollover is happening, and perhaps pricing is starting to come down, but gold's still high. I mean, that's a hope and a prayer as well, but it happens.
But some of the things that you guys have said, and Ryan, come in on this one, is, okay, you got to take the emotion out of investing. You said that. I agree with that. But I need some kind of practical examples of what I should be looking for, because if history repeats, as James said, we're going this emotional roller coaster when we shouldn't be going on anything, no emotional decision making. I think we're violently agreeing on that. Is what do we need to look? What's important to look at, and what's not important to look at? Right. I mean, in this, how do I simplify and strip out the rubbish and focus on what's important if I'm going to be a fundamental investor?
I think it really has to come down to really what you believe in terms of whether it's the asset or the people, right? And to me, people are such a big part of it. Just talking about inflation on some of these projects, and I think a lot of that was actually due to probably some mismanagement, to some basically aggressive behavior in relation to the project. And so I don't think it's all just the inflation environment. And I think, to me, it's all about, I guess, people and project for starters. But I think just as an investor, I think one thing I think that is critical is you look at the different parts of the gold industry in a sense of what you can invest in. And so I would say that the most safe investment in terms of volatility and so forth is literally just physical gold. So that's sort of one end of the spectrum. And then you go down to the other end of the spectrum, which, early exploration would be the most risky, but also offers most return. And to me, it's a matter of measuring, what type of risk appetite you have to be able to withstand the volatility. So if you're someone who just does not like volatility too much, but really, believes in the idea of gold, which we certainly do at Maverix, I would go stick more towards the physical gold aspect of things. And then if you're somewhere in between, I'd probably encourage people to do a bit of a mix of physical gold, royalty companies, producers, and some exploration and developer type companies. So you can kind of feel safe that you've got the whole lane covered.
I think one of the most important things to look at in the development or late exploration phase companies is a lot of companies will go out and say, look, we did our feasibility at 1550 gold or 1600, and these are the numbers. But that's not what's important. What's important are the sensitivities. So looking at sensitivities, what if you have a 10-year, for instance, we have an 11-year mine life at right now at Goldboro in Nova Scotia in our feasibility. And what we like to show is not what happens at today's price of gold, which is much higher than our feasibility at. What we like to show is this still works and generates good profits at $1,200 gold US, because we need to work within a range over the next 11 years, and gold goes up and down. And it's very, very important to look at sensitivities. What would happen if this cost 25% more to build and gold was 25% lower? Does it still work? And looking at those sensitivities gives you the robustness of the project.
Yeah, absolutely. I think it is all about that. I mean, that it goes back to that robustness. And I mean, you've got the people side, but if you look to, and one way for investors to do this is for the producers, it's quite good. You can actually go back and look at them over time and see what the robustness of their, if you want to do some technical work, you go back and just look at their historic margins over time. And you'll find that there's a few companies, certainly over the last 10 years, that do stick out above the others, even through the gold prices we have. And they've had consistently higher margins. And that's come down to 2 points, the assets and the people. So it brings the two together. So you can measure that, but you'll see that actually coming through the numbers. And then you sort of look at their businesses going forward. But again, I mean, I guess going back to the exploration side, you've really got to try and find the outliers, the things that have got higher grades, the things that aren't, the companies there's enough information out there to know that it's not metallurgically complex. There's not something that's going to come with these projects that is, it's not in a part of the world that carries a lot higher risk than anything else. You're just trying to manage that risk in exploration. Just find you are just looking for the outliers, and sometimes you might have to come in a bit later once it's partly been discovered or things have been discovered. But if you're, as Kevin said, if there's a big deposit being found, there's usually going to be something else found quite close to it over time. So that's another way of going at it. You don't always have to think you've missed the boat. If you look at, Great Bear's been an interesting example, hasn't it? I watched that from the sidelines, and they made a few discovery holes. It looked quite interesting, and then it kind of just got better and better and better because they found more nearby. But it's in a well-established area of the world. So I guess again, retail investors shouldn't be too concerned about the entry points ultimately, but they need to make sure fundamentally it looks something exceptional.
So moments like this, these economic uncertainty, it causes a shakeout between winners and losers. There's companies that can withstand the strong winds, as it were, and I think that's great. I think it's great for all industries to kind of go through this. There will be some M&A off the back of it. People need the majors or the mid-tiers looking to fill top up on their resource and reserve numbers for sure. But again, come back to us investors. There needs to be kind of shake up in our thinking, I suspect. Do we need to change the way we think in terms of like this new reality, or will things just settle back down to the mean? What do you think, Ryan?
Yeah, no, I think it'll certainly probably be volatile for the next little while. I think, just generally speaking, you look around the world at various, asset prices and things. And to me, the gold space is probably one of the few spaces that's probably unloved and been unloved for, I would say, a fair while. Whereas you've got other sectors, probably most in the world, that have done very well over the past decade. Whereas gold has been, I would say, on the sidelines almost because everything has done well. And so to me, I think there'll be some volatility, but I think you want to basically gravitate towards sectors and areas that have been unloved, because that just gives you a better chance for a good risk return ratio. And so to me, I think it'll come back certainly. And to me, it's a matter of timing and be able to withhold the money there and without being panicked.
I think that's a very good point, Ryan. It's timing. It's, if you want to buy stock in the morning and you're arguing why it hasn't gone up by the end of the day, I think that's a little difficult, right? So, timing, you got to have a timing perspective that's realistic. So if somebody has a plan to discover gold and build a mine, that's 10 years. So, but it's not going to happen, and the stock's not going to shoot straight up. It's going to go up on discovery. It's going to flatten out if the next holes aren't as good as the first ones, and then it's going to go up again with further. Then it's going to be boring while we're developing and trying to permit, and then and eventually it gets built, and you get a re-rating and how you're valued, and all of a sudden you've gone from a penny stock to a company worth $1 billion, but it doesn't happen overnight.
Yeah, look, it is patient capital. That's the thing. I guess you have to be like that, but it is and Kevin said it's about the timing ultimately. I guess we see too many people sort of worrying about the really short-term impacts, and obviously news these days. Reality of my time investing in Baker Steel 13 years, the difference in the sort of new density of news flow every day was just like got higher and higher and higher and higher. So people's long-term investing became like 3 months for a while there. It felt like, but the resources sector is multi-year. But it's interesting. I think the mining sector as a whole has been pretty unloved for the last 10 years and uninterested. It's had a bit of a flurry of interest on the battery metal sector, but even then, you're really only touching the sides there. So I think it'll be just beginning to see that happen. So,
James, do you think moments like 2020, where momentum was a big? Well, I think it was that was the thing of 2020. We saw big investments back into the space. Commodity prices starting to run at different times, albeit. Do you think that's a good thing for the industry, or because anything that needed to get funded got funded, whether it should or not, whether it should have or not is another matter.
I don't think it's as bad as the past, though.
Really?
Not that many people got funded. I mean, we've been around since 2016, so we started right at the bad times, and then 2020, people started to think, oh, this is quite interesting. But even then, I think back to over the last 20 years, it's the amount of financings you can look at, and they were nowhere near the hype that we had before. Certainly, we have seen that in things like the lithium sector, and I think that's a bit of an issue. You have lots of projects, and not many people know anything about the lithium sector, to be honest. So it's very hard to know. So you've had bubbles in little spaces, but not as a whole. It's a good thing that there's interest back in the space, but yeah, the discipline on the allocation of capital to them back into it. Well, that's.
I think in a bull market, in a bull market, when there's a big peak of people's interest into it, and then a waning of it, as long as it's still a bull market, that actually creates what I call a shakeout of the weak holders, and that just creates a stronger market going forward. If you're in a bear market and that happens, you're going to have the situation where your dollar stocks go down to under 10 cents and people are doing 10-cent specials with their hat handed out. So, it depends on the market, I think, and on the timing, but shakeouts are good in a bull market.
Yeah, and people often view volatility as bad, whereas I guess I take a bit of a different approach and think it's the opportunity. It's the opportunity to buy when things go down, and it's the opportunity to sell when things spike higher. And people should take advantage of that and use that as part of their investment philosophy, I think.
Okay, well, look, gentlemen, I think it's a big topic. We'll probably talk for another 4 hours, quite frankly, on this, and maybe the beer in the hand would be more interesting. But look, thank you very much for your time today. I think, for those watching and listening to this, these are 3 companies which I rate highly in terms of the way that they are run. Some of the things that the guys are talking about today in terms of the teams, the business models, and the business plan, solid here. So Ryan McIntyre of Maverix Metals, Kevin Bullock of Anaconda Mining, and James Withall of Rupert Resources. I thank you very much, gentlemen.
Okay, thank you.
Thanks, James. Thanks, Ryan. Thanks, Matt.
Thanks.
Thank you.
Thanks. Have a good rest of your day.